Hello and welcome everybody to our webinar on financial planning, modeling and stress test, which is organized as a part of MFC activities under SIFTA project. Let me mention some housing rules for this webinar. The webinar is going to last up to 120 minutes, while we are assuming about 90 minutes of the presentation of our speaker, our expert, Artur Muntenau, and we also leave a space for some questions and answers. The webinar is recorded, and we invite you to keep your cameras on, but please keep your microphone muted. My colleague, Karol Kwietniewski, will be assisting you through chat with any technical issues and make sure our session will go smooth. In case you would like to pose the question or comment, please raise your hand at the dashboard. You have an option of reactions, and there you will be able to select raise the hand, and then we will invite you to unmute and speak. Of course, you can post your question also in the chat. At the end of the webinar, we would like you to stay for additional 1-2 minutes to fill in our evaluation survey. It is really very important for us to receive your feedback. So please do not leave before you submit the evaluation survey. Thank you. The slides will be shared via email after the webinar with everybody who registered for this webinar. Let me introduce our distinguished speaker, Artur Muntenau, who is entrepreneur, finance executive, and enterprise development consultant with more than over 25 years of experience. And he has significant expertise from the microfinance sector, since he has been in the role of CEO and also a board member of Microinvest, which is leading non-bank financial institution in Moldova. He was and he is also board member and advisor in several important companies from different sectors, agro-food, finance, and ICT sectors. And Artur has significant experience from Central Eastern Europe, but also from Central Asia. I would like to raise your attention also for our upcoming event, which will take place next week. And it's going to be really an interesting topic. A lot is these days discussed about the financing social economy. And we invited 2 institutions, one from Poland called TISE, and we will have also a representative from a Romanian organization recently established called AFIN, which will share their experience, their questions and answers, also with many other potential providers of financing to social economy. So please keep this date in your agenda. It is going to be the same time as today. So please register through the link which we are going to provide in the chat, but also through our website and social media. For those who don't know yet about SIFTA, SIFTA project brings continuity to EASY TA program, and European Investment Bank under InvestEU Advisory Hub reinforces the European microfinance and social enterprise finance sector and provides support to microfinance and social enterprise finance providers under the window of social investments and skills. The support is given through tailored trainings, workshops, webinars, peer-to-peer exchanges, and study visits on a wide range of topics related to financing micro and social enterprises. The project also delivers rating assessment and evaluation services provided by Microfinanza Rating, MFR. The eligibility of this project is for EU countries, 27 member countries, applicants from these countries, and the time frame of the initiative is with the initial budget until December 2024. The beneficiaries are microfinance providers such as banks and non-bank microfinance institutions, but also social enterprise finance providers such as investment funds, impact investors, incubators, accelerators, but also fintech and guarantee organizations. The technical assistance team responsible for market development activities and capacity building services consist of consortium, which is led by Frankfurt School of Finance and Management, and its partners, Microfinance Center and European Microfinance Network. As mentioned, rating, assessments, and evaluation services are provided by Microfinanza Rating. In case you would have any questions, you can go through the link which is displayed on the slide to the site of the program, or also send your questions to the email which is also mentioned on this slide. So now I would like to hand over to Artur to start with his presentation, and hopefully we will have good time. We will have good questions from the audience. We had really many registered participants, so let's see how many of them will participate, and we are looking forward for your active participation, for your engagement, for sharing of your experience, even exchange. And we will try to do some polls during the presentation as well. And we hope that you will enjoy this webinar. Artur, the floor is yours.
Thank you very much for introduction and for details about SIFTA program. Today, we are here to talk about financial planning, financial modeling, and stress testing. And we prepared for you an agenda, but before that, on several slides and cases. But before that, I'd like to explain and argue again why a financial model is needed, why a financial plan is needed, and why stress testing is needed. So the webinar was designed for microcredit providers, social finance providers, impact finance providers, to diagnose the current status of financial planning and stress testing in their institutions, to decide if they'll elaborate from zero a new financial plan or model, or will improve the existing financial plan and model, to make faster decisions and better informed decisions, to understand the team and skills you need for financial planning and stress testing. Also, we'll show you an example of multi-factor stress test, and you'll be able to set some priorities for you in development of the financial plans and stress tests, depending on your institution growth level or strategy or risk appetite. Financial planning process helps to manage better microcredit or social and impact finance providers based on the approved risk, as we discussed last training during the risk management training, based on your profit appetite, based on your growth appetite and development goals. Financial planning will help you to take faster and better decisions based on data and based on calculations. Too much data is not good, too little data is not good either, so you need to find your balance in this new century full of data and information. Financial plan will help you to better and faster manage your risks and your opportunities that exists in your current markets or your new markets and new niches. We'll be talking about the financial planning process and financial modeling process, which are two different. We'll be talking about the inputs that you need and key assumptions for your financial plan and your financial model. We'll be talking about calculations pages. However, this is not a coding training. This is not a programming training. And moreover, this training is a small part of a comprehensive training on financial planning and modeling, which may take usually 2 days. So this was adjusted to 2 hours to inspire you, to give you some takeaways. And as Pavel was mentioning, to apply to additional training, tailored training from SIFTA on either financial planning, risk management, or stress testing. We'll continue with showing you some output tables and output models, like cash flow statements, PL statements, balance sheet statements, financial indicators and covenants, not less important, as you're borrowing more from different investors and lenders. We'll show and explain you a summary output, which will help you to manage your institution. We'll be talking about stress testing, sensitivity, and what if. And for me, in this training is the same. When I say stress testing, I mean sensitivity, or I mean what if analysis. We'll be talking about specific inputs for sensitivity and specific outputs. We'll spend a little more time on portfolio quality and restructuring. And of course, at the end, you'll have some slides and you'll have all the definitions and terminology for those that are joining the first time financial planning or financial modeling training. The training is for a variety of participants, and we have experienced top managers participating. We also have middle management, and also some juniors and financial analysts that are just starting their careers, or some entrepreneurs who are just starting their social finance venture. So all participants will have some takeaways that will help them to either manage their institution or build their model. We have a poll to understand where you are in terms of financial modeling in this case, and we'll appreciate you to answer the questions. Here are the questions. You're receiving a separate window. Are you satisfied with your financial model? If you have one. If you are a startupper, then you have an answer that we do not have one, we want to build one. So please take a few minutes to answer the question, are you satisfied with your financial model? I hope you all received the special window for polls. Do you see, Pavel, people answering?
Yes, people are answering.
Okay, excellent. I'm sure majority of you have a financial model. And excuse me, you may have a budget, you may call it budget. I'll explain later the difference. The budget for us in this training is a 1 year planning, and a financial plan and financial model. It's a longer term, 3-5 years, or in some cases, some 7 years. So please answer if you have one, and how detailed your financial model is. Do you intend to build one? Do you intend to buy one? These are actually the questions for you. Okay, The answers are, you all see the answers, but I'll read them for you. 56% are answering they have a financial model which is a basic model with financial statements and some cost or per cost financial cost. 16% are mentioning that they have a basic financial model plus sensitivity and stress test. That is excellent, but prefer after this training. So at least 50% of you are using sensitivity and stress testing in the financial modeling. 9% are mentioning that they have a good model with sensitivity plus user manuals. That's great. Or even coder manual or programmer manuals. That's excellent. 18% they don't have one, they want to build one. And 9% are not satisfied. They're looking to buy something or to use an existing model. Okay, and 2% were not satisfied. We intend to buy one software for financial modeling. Excellent. I think the webinar is for you. You are the right webinar, and we're moving to the details of the webinar. Yes. The financial planning process includes several steps. Yeah, and we're talking about financial planning process. This is one process, and financial modeling is another process. So in order for you to do financial planning, you need to have a model, but I'm starting from the financial planning process. Yeah, you need to have a starting memo. Your top managers will send a memo by saying that, we're starting the financial planning, budgeting process. We'll put the deadlines there. The final deadline for top managers, the final deadline for board members, because board will need to approve. Financial department will send some templates if you have them, and that's ideal that your financial department sends the templates to all staff departments, because otherwise it's very, very hard to consolidate data from your company. The second stage is your strategic initiatives and key operational actions approved. Yeah? You need to have already your driving factors, you need to have your products, you need to have your channels, your growth rates agreed with top management and shareholders. Some elements, some strategic elements that your financial department and IT department can take from the stakeholders, from the decision factors, and start to input and start to model. Because otherwise it's very, very complicated. Somebody is finishing a model and then the top managers or the board says, I would like to go to another country or would like to have a new product. And it is happening. But ideally will be to ask your top managers, to ask your board members, what are the strategic directions of the company? What are the driving factors for this year and next years or planning period? What are key operational actions in terms of new products, channels, staff? Are you planning to reduce staff members or to increase the number of staff? Do you plan to grow more than last year, or do you plan to stop the growth and slow down and consolidate? So this is the important information that you need to receive from your top managers and shareholders, or you need to ask. Yeah? Then we're moving to department financial plans. Yeah, each institution has financial department, sales department, risk department, online department, digital department, branches, green department, social department, whatever products, retail products, SMEs products. So what you need to do is you need to analyze your historical variance. if you're not a startup. So you analyze how you perform by each department or by each business line. You need to start inputting data in the templates that you've already received by the financial department, and you need to discuss between departments, because the most time-consuming element is this debate between departments, between the financial department, between the risk department and sales department. Next important element is already to consolidate. Wait a minute. Do you see this nice chart? Yeah, fine. You don't see this menu at the bottom, yeah? Is it okay? You see everything? Fine. I'll ask participants to mute the microphone. If there is any question, please use the chat or raise the hand, because there are a big number of participants, and if microphones are not muted, there is noise, and we want all participants to hear our key messages. So data collection, data consolidation. Yeah, you receive from all the departments all the tables, and as mentioned at the beginning, if they're not standard tables, it will be very, very hard for you to consolidate. And before you were receiving those tables via email, nowadays you can work on OneDrive or Google or whatever cloud data room you're using, and you can work parallel. But there are some issues with some spreadsheets as well, Google spreadsheets, Excel spreadsheets. So if you want to use the classical methods like receiving the tables via email, keep it as it is. If you want to use new methods of collecting data, then make sure that it's working properly and consolidation is done in real time without mistakes. And you consolidate and you present a version to your committee, to your financial planning committee. And of course, they'll say the growth is too small and the profit is too small and you need to increase. Or they'll say there is too much risk in a certain portfolio, or you need to cut staff, or you need to increase salaries because of the inflation, or you need to cut fuel consumption or electricity consumption. So you'll have a lot of debates, and you'll go back. That's usually you'll have several planning sessions. You'll go back and you'll revise it, you'll adjust. And you'll come to an agreement. That's the most important, to have an agreement on the strategic objectives and the impact and the profit and the impact on social and environmental aspects that you are concerned about. Several discussions and interaction with departments, negotiations, several discussions with CEO, with CFO, and kind of first approval by the top management. Not less important is to have in your model what-if analysis and stress test, so that you can change immediately when you present. If your CEO or your CFO wants something else, it wants to grow faster, or it wants to increase the interest rate, we need to see immediately the impact of interest rate growth on your profit. We need to see the increase of fees, for example, on your profit, or decrease of the fees on your profit. So the model shall function well. And then, of course, if the management and departments agree, then you go to you go to your board for final approval, and of course the board will send your budgets back to you. It will be good if this is once. So what is going on? Actually, it takes a lot of time. You may have some, like in total 4 to 5 budget planning sessions, 3 at the top management level, and 2 at the board level. And without a good financial model, it will take even more time. Because you have covenants, you have risk indicators, you have risk limits, You have compliance with national bodies. You have compliance with lenders. You have compliance with new shareholders that just bought shares in your company. So without a good built financial model, it will take a lot of time and data will not be accurate. Now, we've asked you, some of you are using a model developed in-house. Some of you intend to buy a new model. So what are the advantages and disadvantages between a model built in-house, a proprietary model, and a model that you buy or you inherit from your, I don't know, mother company or sister company? So building a model in-house means more flexibility for you. The input design, the output design is in the form of your financial statements, is in the forms that you are used to, you know them well. Cash flow details as you need it. You can add some new cash flow items either on inflow or outflow. Financial indicators as you need it. It might be an automatic and faster input of historical data. If the same IT people are working, so you can import, export automatically from your financial statement, historical data. Nonetheless, if you build in-house and you just started, there is more time needed, and you need to have patience. I know how it is, top management and board, they want the model quickly in 1 or 2 weeks, which is unrealistic. Yeah, you need to create a good model because it's your critical asset. Yes, your critical assets are, of course, your team, your portfolio, your management, loan portfolio management software. But think about financial modeling software and stress testing software as a core asset. It is a core asset for you. You can easily stress test, you can easily take decision, you can easily understand what is going on in your company. Yes, there is an option to buy an application from the market. It might be faster for a startup. After short training, it might be video or it might be face-to-face. You have the financial planning and financial modeling software, so you can use it immediately. It's a professional application development team. You need to ask actually who is behind that application, but usually if this is a software that is there, then they have a professional development team, not only from programmers and testers, but also economists or financial people. Some manuals will be available. Make sure that if you buy, the manuals are available, not only for users, but for programmers. And make sure what you buy a software as a service, or you buy a software that you can build on, you can code, you can continue to program or adjust. A new application for you might be less flexible, but they can develop for you, of course, for service fee. So please understand how much it costs per day, per hour. IT people are very expensive nowadays and very high demand. So make sure you understand the total cost. Financial statements and other output tables may be in different format. You have your national accounting standards, and these financial statements might be some general accepted financial statement standards. You may want to go to IFRS. If that is the case, you need to ask as well your software provider if they have IFRS financial statements in the model. May cost more, although in order to really compare, you need to compute cost for building in-house a model, how much it will cost, and then compare with an external model, how much it will cost. With external applications, usually you may be limited and locked to their programmers. And if this is a small company, if it's a big company, then yeah, they have them, but they're very expensive. Yeah. So this is a simple comparison of building an internal model vis-a-vis using an external application.
Artur, can you maybe mention an example of ready software or application which can be used by microfinance providers for financial planning and modeling?
Yes, Pavel. Microfin is one of the application financial modeling, business planning, financial planning tool. It is in Excel, Microsoft Excel, but is working. It was tested. It has more than 20 years. There is online support. There are courses, and by the way, there is a course in June 19th to 23, provided by MFI Resources. So you may want to learn more about Microfin, the one that was used purely for microfinance or microcredit providers. I know that there are participants which are intending to have funds, impact funds, or social funds. You may try to adjust this software, or you may want to use something else which is available for impact funds and impact private equity funds or venture capital funds. So this is what I know. Microfin, it works. You need to understand it. You need to build it first, of course, input, set up branches, channels, products, funding needs. But it works, and there is detailed web training, and then face-to-face training can be organized as well. So this is what I recommend so far.
Maybe we can also ask our participants. It would be interesting to hear from them if they know or use any other financial planning software for MFIs or social finance institutions. So please, you are invited to contribute and exchange with us if you have any experience, good experience, of course.
If I may.
Please.
Yes, please.
I'm Tima Bečirović.
Hello, Tima.
Hi, everyone. So I'm from EKI, Bosnia and Herzegovina. Actually, EKI is the institution who fully applies Microfin in its planning processes. In every single step, starting from strategic to business to operational. Actually, it's really good tool, and this is something that we are using for years. And also, I'm certified trainer of Microfinance Center for Microfin model. But for the version which was released prior to version 4. So this is actually how we started when I came to EKI. And this is how we started, and actually we are really exploring it in full capacity. Otherwise, I wouldn't be sure how some other tools would be so comprehensive and so good for planning. So this is just from our point of view, the experience, what we do. So highly recommended, yeah. And I'm very interested to see the course is for the version 4. Yeah, Mr. Artur.
Okay, appreciate it.
Yeah.
Excellent. Any other softwares that participants are using so far? You can write in chat as well, so we'll continue if you're happy to share your experience with other ready softwares for planning, modeling, stress testing. We'll appreciate. Thank you very much. We continue. So building a financial model now, what is the process for building a financial model? You need the architecture. It's like a software. You need the architecture. You need the design of the input pages. You need the design of the output pages. You need the design of the calculations pages. And you need data and formulas, and you need to test it. You need to test it, several scenarios, several people, and different institutions or different branches. If you are MFI working in several countries, geographically diversified, you need to test it. And testing is also taking a lot of time. Usually, MFIs are building in-house, they're writing some formulas, not testing it, and rushing to use and apply, and there are errors, and we're talking about operational risks, yeah? So need to test very well your model. There are different levels of details in this financial modeling process, and we've observed by participants answering the first poll, some of them are using a basic model because they want to understand where they are, and they use the financial model as a strategic tracker of financial performance and social performance. So they don't want to go into a lot of details. And there are other institutions which are using the tools for strategic planning, for operational planning, for stress testing, for funding needs, for product profitability. So there are different levels of details. What is important is actually to start with an architecture where you can build on additional tools or additional tables, additional formulas. So we have first level of details, so first financial model where an institution is using average disbursements, average repayments, average interest rate, average inflow and outflows, interest rate risk module and maturity risk. So they're matching assets and liability, and newly they add ESG matrix, environmental and social, and governance risks by reporting how many shareholders they are, how many board members, are they achieving their social mission, if they state that they work with women only, or with youth entrepreneurs, or with districts which have the smallest GDP per capita. So they build that matrix in the model as well. And then you have the second level of details, disbursement details per product. Yeah? If you have 5 products, green, startup, SMEs, retail, you have those tables, those pages, and those calculations per product, including product profitability. Yeah? Portfolio outstanding, portfolio quality, provisioning policy, detailed level of provisioning policy. Yeah, not one amount inserted like this is the provisioning for this year because it was the same last year in our PL account. So interest rates, and all those info you need per products, per branches, per channels, online, partners, branches, risk module, interest rate risk, currency, related parties, maturity, and of course, ESG matrix. For startuppers or for those that wants to build a new model, you can start simple with, building your financial statements, your financial indicators, input tables and output tables. You can start with average amounts, and then you can add, but if you have a team now, and you have the budgets and you have time, you can start developing your model with the level of details you need for future stress testing. So financial model is an investment. Don't look at it that, you need some money to pay it now. Yes, you need, but you can capitalize those costs. is not an OPER cost. You can capitalize investments. Of course, there are some local peculiarities of accounting standards, but your salaries, your programmers, of the team that is testing, of the economists which are participating in the design, architecture, and testing as well, your even travel costs to develop the model can be capitalized in your assets. Yes, later on you'll need to calculate amortization, but don't look at it that you don't have money now, because a financial institution usually is liquid, and you'll find money and time to pay a good team to develop a good financial model if you decided to build a financial model in-house. So it can be capitalized on intangible assets. It will help to faster stress test key risk and opportunities. It will help you to make important decisions. So your success depends on your financial model, actually. Yeah, your success depends on your financial model. I'm showing here a financial plan structure or architecture, if you want. Of course, you need to have a content so that other people might navigate via your model. And we have seen institutions which have financial models, but they don't have a content, and it's not easy to navigate. You need to have model setup page. You need to have products, items, rows for financial statements, branches, yeah, and possibility to add rows or to add branches or to add products. You need to have assumptions and a summary assumptions that can easily present to your board, because to your board, you'll not present 25 pages of Excel. So your core assumptions pages, and I'll show you examples of those pages, which we believe is best practice. GDP, interbank rates, the energy prices, if you want, yeah. Then input pages, and you may have several input pages. You may, start with 2 input pages, but move to, in this example, like 6 input pages. Do it separately so that you can navigate easily, and you can add after that in order to build, all inputs in one page in Excel. Yeah? So disbursement is everything we do, right? If we have microloans as a products, this is what we do. We disburse loans. If we have here investment funds or equity funds or venture funds, they do equity. So they'll have investments. They'll have investment input and may have also several products. Yeah. If it is a micro loan, you may use a repayment schedule and use those monthly averages, or you may use several repayment schedules, or you may input actually the total amounts per those products. There are also 2 options here. If you have your products, of course, you want to distribute the products, and this is your network and stuff. And this might be online or offline. So you want to build inputs here. Then, of course, portfolio quality, portfolio in general, yes, because you want to track monthly progress. You like to have monthly portfolio, not only annual portfolio, because there are seasonality in your business. And having only annual data will help you, but will not help you to track performance every month. Then quality, risk management, portfolio quality. How do we track quality? How do we plan quality? We usually plan for good, but what is happening? It's happening unexpected, and we want to have enough quality data to stress test. Restructuring portfolio, write-offs, loan loss provisions, all those data are important data for stress testing. Yeah. Then we move to funding. We need funding to grow our business, and funding is available and was available and is available for the microcredit providers if institutions are in growth stages and mature stages. Funding for microcredit startups and early stage microcredit institutions, funding is scarce, is not available. That is why you need to plan several funding products as well, like debt, savings products, bonds, maybe equity, some guarantees if you want to build it in. We have European Investment Fund guarantees for microfinance providers. So funding table, a very important table. Funding structure, ideal capital structure for you. Capital expenditure, if you're planning a new headquarter or you're planning rebranding of your branches into a fresh, greener style, you want to put some photovoltaic on all your branches and real estate that you own as an institution. You want to drive bicycles, electrical or classical, or you want to drive electrical cars. All this are capital expenditure. If you are truly into ESG and SDGs and you want to become a green microfinance provider, you'll need to invest. You'll need to plan those investments separately and see the impact of those investments on your profitability and on your strategic growth. Operational costs, of course, admin costs, you adjust your salaries for inflation or you don't adjust them, how people react. You're increasing your salaries, you delete stuff, you're moving online. There were a lot of topics on digitalization. People are saying that hybrid model is the best model. So you need to invest in both models to attract different client segments. So OpEx costs and admin costs. And then, of course, we're moving to calculation tables. Calculations, again, you can have several tables, and I'll show you some examples. We can have income, which is, what we want to have because we want to have sustainable financial institution. Portfolio at risk, loan loss reserves, recovery, projected funding needs, cost of funding, and of course, financial results and financial statements. And usually, financial departments are stopping here with financial statements, but you need to continue. You need to continue your model to, details cash flow, direct method, not indirect method, because you'll not be able to track your cash flow monthly. We were talking about cash flow and liquidity risks. Yeah. So you need details, direct cash flow, not only indirect cash flow. You need financial indicators because you have lenders, you have the covenants, you have a national bank, so your supervisory authorities. You need to have all those indicators in the table, not in a separate model, in the same file, in the same application. What if analysis, and not only one factor stress test analysis, but multi-factor. We'll be talking today about this. And ESG, again, what is your mission? Your mission is to work with your Roma clients. Your mission is to work with people with disabilities. Your mission is to work with women-led businesses or women-owned businesses. What is the share of that portfolio in your total portfolio? So build the ESG table here in your model so that you can easily track after that. And if you change something in your model, it will work. Yeah. For smaller MFIs, you'll have smaller number of tables. You'll have averages, one product average, microcredit product, and that's it. Then you have the interest. You'll have average interest, and if you have branches only, then how many branches and what is the average cost per branch? But I'm advertising for, and I'm trying to convince you for more detailed model. Nonetheless, for startups, you have also a model here. Okay. So financial plan structure for smaller startups or earlier stage MFIs or social finance funds: apply one loan product or investment product, one average repayment schedule, several assumptions related to bad debt, depending on the structure, on the strategy. I don't know, portfolio at risk 5%, portfolio at risk 25%. Let's see how is your institution performing. Can you really accept more risk? Can you accept 50% portfolio at risk? If yes, who will cover those losses? Yeah, imagine 50% of your portfolio is not coming in your bank account next year. So how will you manage those institutions? You need probably grant money, or you need government support, or commercial lenders will not provide you any new lending capital if you have a par more than 8% or 10%. Yeah. Operational admin expenses, and go to cash flow and see every month what cash you need for disbursement operational costs, and you have your simple financial model. We have another poll here. What type of financial model are you using? Developed in-house, built by third parties, software as a service. And software as a service, we mean you pay every month per a fee for using that service, that software. Software product that was bought, but is not software as a service. You bought it once, you pay 10,000 euro, 5,000 euro, or 7,000 euro, 1,000 euro, and you're using it. And you have a software product that is used for free. Remember open code or open source applications. If you're using that software, please answer as well. Okay. Developed in-house. So 39% developed the financial model and financial plan in-house. 27% built by third parties and improved in-house. And software as a service, 16%. Okay, so you're using software as a service. That's also excellent. Software product was bought, 14%. And software product is used for free. Okay. So if we look, that means that less and less people are developing in-house the model and using some external service, some external programmers or some external help for financial modeling and financial planning. Yeah, IT is developing, digitalization. So more and more products will be available on the market, but make sure that there is continuation with their product as well. Remember, this is a core asset for us. A financial model is our core asset. Financial model is our success. Example of input pages. So during the presentation, you'll have more examples on the tables. So you'll have them. You'll receive all of them, and you can compare with your existing models, or you can ask Microfin if they can adjust for you, or you can ask your supplier if they can adjust for you if you think the tables presented are excellent presentation for your financial model and financial plan. So we start with macroeconomic assumptions, GDP growth rate, remittances growth rate. If remittances is a driving factor for your business, remember, for some of the countries, remittances is still a driving factor. Inflation rate, we talked about inflation during the risk management training. Inflation rate will still be high. Local currency vis-a-vis foreign currency, vis-a-vis USD, euro, or if you in Asia trading with Chinese yen or Japanese yen. So interbank rates, local interbank rates, check your national banks, treasury bills. And if you're borrowing on floating interest rates, it'll be good from the very beginning to build in LIBOR 6 months, 3 months, 12 months, or Euribor 3 months, 6 months, 12 months. Social fund tax rate, profit tax rate, and other tax rate. These are the core assumptions for you. Energy prices, if suddenly your energy bills went up and your clients in the alternative energy sector, energy prices went up, now they're going down, it's very, very volatile. So if you have an energy price factor in your model, you can easily actually model and see the impact on your sustainability, on your profitability. Of course, we have total disbursements, as we discussed, and growth rate. Yeah, some institutions, they have total disbursement in amount, but they don't look at the growth rate. Growth rate is a good rate for presentation for your board, for your lenders. Yeah, what growth rate are you targeting next year? Average maturity for your investments, for your disbursements, important to know, because you want to match it with your average liability, average employed capital. So it's a good presentation number. Effective average maturity, there are different financial indicators, and then you go at gross loan portfolio at the end of the year, or gross loan portfolio at the end of the month. Here you have the presentation per year, but I recommend you to budget, to plan per month. And then you group in Excel. It's very easy, Microsoft Excel, but if you use Google spreadsheet as well, you can group and group. So use monthly disbursements and monthly gross loan portfolio, because that's good for your performance, for your productivity track, and for your variance analysis, variance over plan. Then we move to revenues. Yeah, we need to make money in this business too. We have a social mission, but we need to make money. So average interest rates, average disbursement fee, average fee income, and if you changed your price, that's very interesting. Now it's getting complicated because you are changing your pricing policy. The board analyzed, or risk managers analyzed and said, we need to change the pricing policy. So if you change the pricing policy, you have a problem with your model, because you don't have options for different pricing. So fee income or loans disbursed before, let's say, you change the pricing policy, it's one, but from the pricing policy change moment is different. So you need to build this in your model. This will help you, yeah, because you need to manage your interest rate margin, and interest rate income and interest rate costs are your key variables in your model, and you need to be able to adjust the pricing policy. Yeah. Then let's not forget about penalties for late payments, for late interest rates, and percentages of portfolio at risk in arrears, percentage of interest receivable past due. So there are a lot of important details for you in this model to comply with national bank requirements, supervisory or lenders. And then we arrive at our core asset, staff, our team. Of course, they're organized in branches. How many branches? Are we increasing the number of branches? Are we decreasing the number of branches? Cutting the branch down, changing the office? Total number of staff, total number of loan officers or investment officers, total number of channels, legal and collection staff, if we have, or if we outsource. If we outsource, we need to have a separate table on that too. And yeah, total number of staff members. Portfolio at risk, I'm not going to details here, but you have the portfolio at risk per number of days of arrears. not only portfolio at risk more than 30 days. You need to have details, portfolio at risk per number of days of delays. Yeah. Restructuring portfolio, sooner or later you'll do restructuring, you'll have a restructuring policy. And write-offs portfolio, sooner or later you'll write off. I remember we worked in one country, they say they're not writing off at all, they're keeping everything in the balance sheet. If you keep everything in the balance sheet for more than 360 days, you need to provision 100%. So depending on your business model, on your local regulations, you'll need to have at least portfolio at risk tables, restructuring rates, and write-offs rates, okay? And you'll have a lot about recovery, which I'm skipping now, and low loss provisioning, which is based on your recovery. And if you move to IFRS, then it's getting more complicated. You'll have probability of default ratios. Yeah. If you're a startup and you're not doing IFRS, then you'll have a simple provisioning ratio based on number of days of arrears. You have the tables, you compare tables with your models, and if you believe something is missing in your model, you add to the model. If you'll have questions, you can email us after that and we can help you, or you can apply for SIFTA and we can have a detailed diagnosis of your model and we can help and adjust, improve, build your model. Funding is crucial. Some MFIs are struggling to get new funding in this crisis, geopolitical crisis. MFIs which are close to Ukraine, some MFIs which are starting up in Western Europe are struggling to raise money because in Western Europe the microfinance evolves differently, and yeah. How much will you pay for your loans? Will you only borrow loans, or you'll have equity? What type of equity, preferred or common? Will you issue bonds? If you'll issue bonds, what price? And if you collect savings or deposits, if you allow collect savings or deposits, at what price? Or if you are crowdfunding, how much you pay your investors? If you're only online collecting money from individual investors. So funding assumptions and then products. Don't use more than 5 products. Keep it short. Too many products is too complicated. One product is also not okay for you because you'll not be able to stress test if agro portfolio is not performing well. Yeah, and in agro sector you have I don't know, more than 20 subsectors. So you want to know if there is a drought in north part of your country or south part of your country. What is the size of that portfolio, and how the PAR will be influenced by your portfolio in agro sector in the north part of the country or in the south part of the country. And you actually, what percentage of that product in the portfolio, you're using average loan size to define your product. Average loan size by initial contract and average active loan size or actual loan size. And then average loan tenor page product. In this case, is 24, but you may have mortgage loans, you may have alternative energy products, which are 5 years. You may have house improvement loans, which are 3 years. Okay. And interest rates and disbursement fees. So this is a nice table for product setup. Then you have numbers of loans disbursed per product. And if you have numbers, you have average amount, then you can compute portfolio and repayments. And at the end, you'll have a portfolio like that. Different people are building different vintages, but usually here are the months and here the number of years. So it's better to present this table. but you can build the numbers in the rows, number of years or years in the rows, and months also in the rows, and you can group one group. It's depends how you're used to work, but we prefer this table, like number of years in the column and number of months in the row. Okay. Then we move to calculation pages. And yeah, calculations, formulas, if we're good at it, if I'm not good at it, better to use Visual Basic for applications, for programming, better to use some certified Microsoft VBA programmers, but don't delegate 100% to a programmer. Programmer will do it how he will see. But you need this for management. So management needs to lead the architecture and the structure. Managers will not write the codes and formulas, but a synergy between programmers and managers and financial specialists will be ideal. Do not insert data in the formulas. Do not make formulas too long. Just look where your model, if it's too long and you don't understand it, just move it to another page, move it to another cell. Create additional separate calculations page or table instead, and test and test again your model. So team, usually it's one person building the model. Okay, one junior and one senior, maximum two, but ideally will be 2 to 4 people to include 2 programmers simultaneously, and simultaneously you can work on several pages if you agreed on the design and on the architecture, and you can then compile and at least 2 people testing, testing and validating the model is very, very, very important for you, right?
Yes. Artur, you are mentioning about the team composition here, who should take care about the model, but what is your experience? How much time does it take to build the ideal, the ideal one? Yes,
Pavel. Depends on the number of people, but a simple model will be 1 month, and a more sophisticated model will be 3 months. But attention here, because you really need to work in that month, not only 10% of your time. Usually, how's it happening? Financial director or maybe chief accountant and financial analyst is working on the model, but they're working on a lot of other tasks. They are member of credit committees or member of risk management. They are complying with national bank requirements. They are preparing financial statements for board meetings and so on and so forth. So what remains for the financial model is not really 1 month. Yeah, I'm talking about 1 month full time, which may be spread by 2 months or 3 months if you work half time on that. But 3 months will be an ideal time to build a model. And again, I'd like to remind that this is an investment. This is an investment, so don't postpone it. Don't postpone it too long. Write the manuals for it as well. We'll be talking later. And look at your people if they like building models, if they are happy with spreadsheets, if they are happy with testing. Don't delegate this assignment to an accountant which does not like at all. The job of the accountant is to book in accounts. Is not to build the models. There are accountants which want to grow to a financial director, to grow to other positions, and they're satisfied with working. First, they have the skills to work in spreadsheets, whatever, Microsoft spreadsheets or Google spreadsheets. So skills of those people are very, very important. And if you don't have them in-house, just find a VBA Microsoft certified person to help you with the programming, with automatic import and export. Yeah, takes a lot of time for some institutions to import and export data from the core management system of the financial institution. So look at the skills, and then if you have good skills and minimum 2, maximum 4 people, from 1 month to 3 months, you'll build your model. Okay. And every year you'll adjust. That's, you want something else, you want a nice chart, you want a nice variance of a budget table. So Microfin, it has probably more than 24, 25 years now. So yeah, improve every year. Okay, good question. If there are any questions, please write in chat. Okay. Or you can always email us. We're continuing. Output tables. So we have elements from everything. We have elements from outreach, which is number of branches, number of clients, value of loan disbursed. We have balance sheet, of course, not the detailed balance sheet, but some elements for presentation. I'm stressing out here for presentation for top managers. Top managers and board members don't have time. They don't want to see 25 pages. They want to see a nice summary. And this is a nice summary. Can be improved, of course, as well on outreach. For example, number of clients owned or led by women, or number of clients in alternative energy. Yeah. But after that, you have gross loan portfolio, loan loss reserve, total assets, total liability borrowings, total liability savings, current accounts, total equity, and the income statement, revenue, financial costs, yeah, net income, net margin. Key ratios, gross loan portfolio, portfolio at risk, write-offs ratio, return on equity. Your shareholders are expecting an equity increase. They expect equity higher than the inflation. This is what discussed last time on the risk management. Right? They want to see this in the table. Yeah, cost to income ratio, operational self-sufficiency, yield on the portfolio. And you want to see, funding requirements. You want to look at this table and know, okay, my plan for next year is to raise 2 million euro, or my plan is to raise 1.3 million euro, in new funding or in refinancing. So you have your key objectives here to manage your institution. It's like in your car, you have only few indicators, few lights, red lights and other colors, and shows you that something is wrong. But when you go to a service, they put another computer in and they have more indicators. So you have a summary table. Then if somebody is interested in more information, then you can open another table and satisfy the info requirement. But you have a summary table which looks like that, and it helps you to manage the growth, the yield, and the new funding. Yeah. For output pages, use your standard financial statements that are used in your MIS. Don't have in your financial plan some design and some tables for financial statements, and in your core management system, different financial statements. Synchronize, make sure that you have the same visual presentation of the reports. Use your standard financial indicators, formulas, including indicators used for covenants with creditors. And I know it's complicated there because the indicators are different. If you manage 24 different lenders or 10 different lenders, it's already very complicated for 10, but 24, 25 will be even more. Use some group one group functions to shorten for presentation purpose, because you may have portfolio quality indicators like different formulas, show only one or two, and then group on group. But other lenders will have, other formulas like portfolio exposure, portfolio quality exposure vis-a-vis owner's equity, not portfolio quality vis-a-vis portfolio only. Yeah? So use group and ungroup. For visualization, use Power BI. Power BI is a nice presentation of budget variance, a nice presentation of your financial plan. It's a business analytics service by Microsoft. It aims to provide interactive visualization and business intelligence. It's really good, bad. You need to have one person that is experienced in Power BI. Okay. And now we're writing out another poll to understand how did you perform vis-a-vis your plan last year. And this is for institutions which have a financial model, which are not startups. So how close are your MFI actual data vis-a-vis financial plans approved in December? Or when did you approve that? No, November. So we're talking about 2022 results vis-a-vis your financial plan. So it's interesting to hear your views and how did you perform? You performed very well. VOP means variance of a plan, okay? So this is actual data vis-a-vis financial approved in December. How did you perform? Of course, we talk first about profit, of course, but you can apply for profit now, but later you can apply for portfolio growth. You can apply for your income and all other indicators, but first is for your profit. Yeah, how close is your MFI actual data vis-a-vis financial plan approved in December? So talking about profit. Have you outperformed or have you underperformed? It's interesting to see how we have done in 2022. We recommend all MFIs to track monthly variances of a plan. Here, the question is about annual variance, 2022 actual data vis-a-vis 2022 plan data. Okay, do we have the results? Okay, wow, 14% more than 50%. 7% 25 to 50, 10% to 24% outperformance, 29% of the respondents, 32% of the respondents outperformed by 10% from 0.1 to 10% to 9.9. Excellent, and we still have some 7% underperformance, up to 10% underperformance, and 4% of respondents with 10 to 25% underperformance. Yeah, I mean, this is unusual to outperform by 50%. That means either you are too pessimistic on your planning, or you're too good negotiators with your board members. I would expect, an outperformance of 10 to 20%, but it's happening. So that means you need to improve. For managers, they need to be more realistic. For board members, if they're present here, they need to negotiate tougher with management. For financial department, which in a way is a controlling department, financial department needs to negotiate tougher with the sales department as well, and to negotiate with risk department as well. But you can apply this, and by the way, you'll have all these questions in the presentation. You can apply this as a diagnosis for other items as well, and to see maybe you need to improve your model, not your plan, but your model as well. So maybe something is wrong with your formulas, or something is wrong with some of your elements in your model that you underperformed or outperformed. Yeah. We want to eliminate the external market factors, or want to look at internal factors if our model is working. Yeah. So go back to your model and look at it and see if there were any, information missing or errors or formulas. Yeah. Okay. Appreciate your time. Thank you very much. We're continuing. Sensitivity. Yeah. This is what is missing from the majority of financial plans. And we recommend you sensitivity with multi-factor. We're not talking now about one factor. We're talking about 3-4 factors at the same time. And you'd like to have minimum 3 scenarios in your output tables. Decrease the branch, increase the branch, decrease the number of clients, increase the number of clients, reallocate a part of the money from your portfolio from retail to SMEs, or from SMEs to retail, or from micro clients to medium clients, or from medium to micro, or from agro to energy. You have a variety of possibility to stress test your model, but this is the presentation. You need to present several scenarios, and you'll see the outreach indicators, and you'll see income statement, revenue, and portfolio, net income per each scenario. And of course, you need to make sure they're satisfied with the realistic scenario, that you can deliver a realistic scenario to your shareholders and stakeholders. When we talk about stress test, there are definitions at the end of the presentation, but when we talk about stress test, there are 2 different stress tests. Yeah, there is one which you're doing in Excel, electronic virtual stress test, and there is one that you can really do physically. I'm not saying now you need to throw dynamite, or throw a hammer into your door of your branch to see if it's okay, but you may stress test if your alarm system is working, if your fire alarm is working, if your fire extinguisher is working. You may come during the night in the office and see if you can get in the secret area or not acceptable area. So if you are an internal auditor, or a person responsible for internal control, you can do physical stress testing. Yeah, I just needed to mention here this training. We're talking now more about stress testing, virtual stress testing, Excel stress testing. But please remember that stress testing is much more. Okay, and when there is a need for internal control, or internal audit training, or consultancy, we can help you, or other colleagues from MFC team or SIFTA team can help you with improving your internal controls, okay, in internal audit processes. So if you come sick in the office, will you be allowed to work, or will you go home? If you come from a trip, from a conference, are you in the office or not? Maybe bring some viruses, hope not, but there are some rules, and you need to make sure that those rules are respected. Also, when we talked about stress testing, we need to put the opportunities as well, not only the risks, that disbursements will drop. Use this table and put more opportunities, increase disbursements. Increase disbursements in green energy, or increase disbursements in organic agro-food, and see the impact. You have 2 columns. You have the profit, the final profit of the company, and you have the impact of this action. So in this example, if you increase the disbursement from 220,000 to 250,000, the net impact of this action is 1.8 million local currency, whatever, euro or Polish zloty. And if disbursements will drop, from your model already that the impact is minus 6 million from the profit, and the profit will drop to 5 million. Okay. So this is a simple table, but in order to present this table, you need to have your model working properly. This table will be understood by every board member or shareholder or stakeholder. Okay. So look at risks, but look at opportunities as well. Yes,
Artur, if I may ask, what other
Please.
opportunities do you foresee? How to stress their impact in current environment?
We see opportunities in alternative energy. Yes, the prices are volatile. Nonetheless, energy independence, intention to be net zero on carbon neutral, that means more more loans, more investment products for alternative energy, and also more loans for greener economy, which is modern alternative energy. It might be organic agriculture, it might be circular economy, it might be innovation in recycling, and behavior as well. I presented the planning process. It looks like a lot of wheels, and it remembers me of some sophisticated bicycles. But if you come back to your office every day, you come in the morning and you go back home every day with your bicycle, you may reduce your CO2 pollution by 100% actually. Or you may put the first objective to, reduce your pollution, your staff pollution by 50% or by 30%, 50%, you can calculate the impact. So there are opportunities by behavioral change within microfinance institutions, but opportunities with the new client niche or with the existing clients, but new products. There are other alternative products like equity products, like leasing. Of course, these are different business lines, but these are opportunities, and you need to stress test. You need to reduce your electricity consumption. You need to produce alternative energy, and you start with behavioral changes, and then move to new client niches, and you compute those opportunities there. Don't decrease your interest rate because you want to serve a certain niche, because by decreasing the interest rate, you'll cut your profits, you'll cut your sustainability. Inflation is very high. Don't be first to cut the interest rate, especially if you're a small MFI or financial institution. If you have a niche, then that niche will pay the price because they don't have access to other financing. We may talk again in a different webinar about new products, but now it's for you to stress, and this list may have 10 items here on opportunities and may have 10 items on risks as well. Can we work with less stuff? Can we work in another country? Can we work from a different branch or from a different headquarters? Let's move from a very expensive city center office to a smaller office or greener office outside the country. So this will be in conformity with your ESG mission. These are the opportunities that I see. Okay. That's okay, Pavel.
Perfect.
Dear
Thank
colleagues,
you.
write as well if you have other opportunities or other risks that you don't know how to tackle. Let us know, and as a group, in collaboration, remember, one of the SDG is collaboration. In collaboration, we can solve them. So stress test is not only about risks and losses, but about opportunities as well. We have a poll here. The question is, have you discussed your scenarios with your board? Is your board interested in scenarios in general? Or your board wants a 1 million euro profit and that's it? Or your board wants a 1 million euro profit in certain areas with the smallest GDP in the country, the poorest areas, and that's it. So we have two questions here. Was your worst case scenario discussed and approved in December? Yes, no. Was your best case scenario discussed and approved in December? Yes, no. We really recommend you to discuss those scenarios with your board as well, because they allowing you capital, they invested the equity, and they may invest more equity in your institution. Are they aware about all the risks? Are they aware about all opportunities? Yeah, okay, please answer. Okay, so 50-50, 52 to 48 answer. Was your worst case scenario discussed? Good. Half of you discussed and half of you have not discussed. We recommend you to discuss the worst case scenario as well. It's good for management. I'm sure the board don't want to hear that, but it's good for management to inform what risks exists in financial institutions and impact financial institutions or social financial institutions. Best case scenario, yes, it looks like 65% discussed best case scenarios usually. It's good to discuss the base case scenario as well, not only the worst case scenario. If you discussed only bad news with your board, they'll change the management sooner or later. So you need to balance, you need to bring some good news. Discuss, but presented in a simple way. Present the tables that we show to you, and explain that besides those simple tables, you've crunched numbers and you've crunched a bigger number of scenarios and you've discussed with your team. It's not a one-man scenario prepared by CFO or one-woman scenario prepared by CEO. It's a team scenario that was discussed, and we were aware about the risks and about the opportunities, and we decided to take few risks this year and to take few opportunities this year for pilot stage or for growth stage. Excellent. Good. We have a lot to learn from each other. So I'd like to remind you this table, which shows about impact and likelihood, probability. Don't show just scenario that, this is the worst scenario, but what is the probability of that worst scenario, likelihood? And don't show, the best scenarios without probability of achieving it. And mention some external factors or some conditionality. So the best scenario will happen only if on the macro trends, macro data, we have this and that. And worst scenario will happen only if on the macro data we have this and that. Okay. And your growth rate is one of your factor. You may grow by 10%, but you may grow by 25%. And we've observed a number of institutions which are not growing. And that's a risk. That's a risk. If you're not growing, you either need to think about merging, selling, or closing down. And if you're growing too fast, you need from time to time to slow down and analyze your portfolio, because your growth may bring some surprises. Okay, so portfolio growth, don't decrease your portfolio, because if you stop lending, your portfolio is shrinking. And if your portfolio is shrinking, your portfolio quality ratios are very bad, will look very bad, and your results will be bad as well. So make sure when is your time to sell, or to merge, or to transform, or to restructure. I was talking about company restructuring, but now I'm talking about loan portfolio restructuring. If it's a geopolitical crisis, if it's an energy crisis, a COVID or pandemic crisis, you want to restructure for the winter only, for 3 months, for 6 months, for 12 months. Make sure that you understand the impact of restructuring, and you can stress test with your model portfolio restructuring. Because if you restructure, 60% of your portfolio without informing your board or your shareholders, without discussing with them, what is this means? What is the impact on your liability? What is the impact on your business future? Yes, you want to help the clients, but are your investors and lenders, which are also clients in a way, are they satisfied? So when we talk about stress test, we have a table like that in the model, and we have different factors like portfolio growth, portfolio yield, portfolio quality, overhead expenses, cost of funds, reduced access to debt. And you can actually automatically click if this is on or off, and you can do multi-factor stressing. Otherwise, you'll not be able to do it. You'll do manually one factor, you'll write manually the impact, and then you'll change another factor and you'll write manually the impact. You need to have such a table. You automatize the table actually, and you put a button off or on, and you can actually put a multi-factor table on, and you'll have the result. Yeah. So increase by 20% portfolio. We may increase by 40% the portfolio. Portfolio yield increase by 1% or reduce by 1%. Yeah. Here you have only one factor, portfolio quality. You see other factors are on. But if you change all the factors on, you'll have the impact on your profit, liquidity, financial indicators, covenants, and if you are finally decreasing your owner's equity, which is key for the financial institutions. So here you see you have the table with all the factors on. On the portfolio quality, you could add other factors, restructuring rate, write-off rate. Excuse me. So multi-factor stress test. If you have this in your model, then your model is ideal. If you don't have, you need to build it. It will help you to take fast, informed decisions and to answer any questions by CFO or CEO. Okay. Now we have a question about restructuring for you. Have you done restructuring last year? Portfolio restructuring. I mean, portfolio restructuring. Please answer the question. Did you restructure a part of your portfolio last year? And this ratio mentioned here is related to total portfolio, because you may have a ratio related to total equity of your institution. This is related to, excuse me, total portfolio.
The form is not coming up.
It should be on just now. Can you see it?
All right, thank you. I'll let you know.
Artur, and I suggest to come up towards the conclusion. I think you know, with the stress test, we can also continue separately on specific webinar in future.
Yes. Yes. It's not coming, Pavel. So maybe we. Anyway, you have the slide, so you can answer later. I don't.
It's not on your screen. I have it on my screen, so I don't know if the participants don't have it. But I see 16. Okay, 31 replies.
Okay, fine.
As of now. So some people definitely have access. Apologize for those who have not. And Artur, do you see the results?
I don't see the results, so if you can read for us,
okay,
I will appreciate a lot.
All right, so let me see. 31 participated, and but this is worst case. Okay, but I see the scenario, financial model scenarios. I don't know. I mean, this was the previous, right? So, Carol,
yes, maybe I will retry to put the poll again.
Okay, because this poll has
it's okay. Okay.
All right.
Yeah,
so now we should see. Now we should see the up-to-date one.
Did you restructure part of your portfolio? Financial industry and financial products are very interesting products because the risk is not only on the interest, but the risk is on principals, all right? So the principal may not come back in time. And what we usually do, we restructure for those that is possible to restructure, for those that still exists as a business, as a micro business. Yeah, we have the results. So what is happening is up to 10%, 50% of respondents restructured up to 10% of the portfolio. 80% of respondents restructured 10 to 20% of the portfolio. Yeah, and we have 8% which restructured 40% of the portfolio, and 80% restructured more than 40% of the portfolio last year. Yeah. So restructuring, it is happening. The question now is, have you had a limit in your policy? Was that limit of 40% or more than 40% discussed and approved by the governing bodies of your MFI? 40% and more, it's alarming. I hope you all discussed with your board and they understood. And if you're 100% financed with equity only, equity is long term, so there is no impact on your maturity risk or your ability to repay your loans. But if you are financed, let's say 70% of the portfolio with debt, and you've restructured 40% of your portfolio, then you may have an issue with your lenders, unless you have already restructured your liabilities as well. So yeah, next slide. Thank you very much. Excellent. You'll have these answers, and please analyze and make sure that you are doing the right restructuring and you are doing in conformity with your internal policy. If you don't have a restructuring policy, please approve one and put a limit in your model. Yeah, you put a limit, you put a red color, and immediately when you stress test, you'll see that you are breaching your limits. So don't forget about liability restructuring. If you've done 40% of your portfolio restructuring, don't forget about liability restructuring. Yeah, an impact on the cash flow. And here you have a table for you to apply different scenarios. Different lenders, one lender is not willing to restructure the debt. Few other lenders are willing. So you build different scenarios with your lenders. 40% of portfolio restructured means that you'll not have 40% of cash to repay your debt providers. And you need to build different scenarios, how you're going to repay those debt providers. And if you have a model with maturity, with portfolio restructuring, you'll be able to simulate different scenarios. We have here 6 scenarios for cash flow, for restructuring liabilities, and for matching your assets with your liabilities. If you're 100% financed with equity, and if your equity providers approve the 40% restructuring rate, you're fine by the compliance risk because you're complying, your rules were approved by the governing bodies. But if your national supervisor is not allowing you to restructure 40%, then you are in breach with your national supervisor. Or if your lender is not allowing you to restructure more than 10% and you restructured 40%, you are in breach with your lender covenants. You're actually in technical default. Yeah. So all those limits, if you have them in Excel in your model and you simulate before you do the restructuring, your top management is asking, can you simulate, please, if we restructure 40% of portfolio, what is going on? You immediately have, we're breaching this and that and that. So you have a 5-minute or 10-minute answer for your board. So that's the beauty of having a good financial model. You can easily stress test based on key factors and drivers before doing any restructuring or any new product or any new pricing change or any new pricing increase or decrease. Okay. So another poll, is your board open to discuss scenarios, or does it want the most realistic plan? And he is not willing to discuss scenarios. So how is your board looking at your financial plan and financial model? Because again, I mentioned the board may say, I want 1 million profit as a shareholder, and this shall come from women-led businesses or youth finance businesses. This is my mission to help youth entrepreneurs. And that's it. How we do it, I know I'm not interested in scenarios. Excuse me. Excellent, excellent. So your board is informed, your board is open to discuss 82%. For the 15%, you may want to convince your board members to look at some scenarios. I understand they're very, very busy people. But if they're not looking at some worst scenarios or best scenarios, it will be a surprise for them if in August or in July, you come to them and say, yeah, we're not meeting the targets. We have a problem, a bigger problem. We want to restructure 40%. It's a shock for them, right? With a scenario, you prepare them that if we restructure 40%, we may lose so much money, or this might be the impact on the cash flow, and we need the new equity injection. So this is a scenario. So you prepare the board. Because raising the equity or raising new debt means 6 to 12 months. So that is why you need your financial model to stress test and prepare your key actions. So if you expect 40% restructuring of portfolio, you need new liquidity, which may come from where? The equity or debt, or new bonds, or crowdfunding listing. So you need actions, you need people to fundraise, or people to put loan dossiers on the crowdfunding platform. So you use financial model to better prepare your team, to set up priorities, to set up your actions. Thank you for the answers. We have a few more slides. Manuals. Don't forget, write manuals or you'll rewrite the model. People are moving from one country to another. They want new challenges. They want to work in another company. They develop your model and you don't understand it. So you recruit any person and they need to build a model and they need to spend again 3 months. So we're talking about user manuals, but we're also talking about coders, programmers manuals. Yeah. So involve more people, including external specialized firms, if you need to write those manuals. You don't need only manuals for your IT core system, but you need manuals for your financial planning and financial modeling and stress testing. Those manuals is a good practice. It's continuity. You build your experience with your company, okay? And experience remains in your company. So you need manuals. And in conclusion, analyze your financial models and conclude if you have a stress test sensitivity, especially multi-factor stress test page, yeah? Including some ESG, is coming more and more often. Analyze key assumptions, the list of variables you assume, the list of variables you want to change, like portfolio at risk, restructuring rate, sales growth, average loan, eco-green loans in portfolio, use loans, products. Have all your products there and make sure that your software, your plan, your model can add a new product. You know, we need to be very dynamic, and dynamism is coming, agility is coming from the model you built, right? It should be well customized and adjusted. So you can add a new funder, you can add a new shareholder, you can add a new product, you can add a new covenant, a new restructuring rate in it, okay? how big your formulas are. If you just open, you are not a programmer, but you open a cell, you open the model, you open a cell, and you look in the formula and you don't understand anything. It's too complex, too complicated. Just avoid that. Just avoid that. Use some simple formulas. You can build a model with simple formulas. Withdraw all data from formulas, insert separate cell so that you can change, stress test it, okay? Link all formulas to data cells. Build a separate page module on each factor for stress testing. Then a summary of multi-factor stress test. Because when the crisis is coming, usually it affects multi-factor impact, multi-impact. So you need more factors in the multi-factor stress, okay? I mentioned that stress test electronically, but don't forget that you need to stress test physically. You need to check if your fire extinguisher works, if your server backup works, your the electrical generator works, your top management is not traveling in the same car or airplane, not on the same bicycle. So you need to have some rules, and you need to respect those rules and stress test and observe if you are respecting those rules. We don't need to have rules in the company just for the rules. We need to have rules that helps us to succeed, to help more people to move out of the poverty, to help more people to produce alternative energy, to help more people integrated from the people with disability, integrated in the community. Excuse me. And if this is your mission, you need to have those products and those variables in your model. So in conclusion, building or adjusting a model starts with architecture, starts with design input, design output, with calculations, with input data and writing formulas, with model formulas and testing, and approval of the top management and of the board. The board is to apply the plan, not necessarily the model. But again, it's a challenging question. It's a question to you. Shall you approve your model to the board or only the plan? My view is, only the plan. The model is a top management job. It's an asset of the company, can be capitalized. And again, don't forget about presenting risks and opportunities. There are a lot more opportunities how you can grow your portfolio, in what sectors, in what segments, monitor segments, plan segments, and then you'll have variance via budget, variance over budget via products or sectors or segments, okay? Make your financial plan and budget a working tool. Make your stress test a working culture. A working culture. Don't decide without any stress test. If you buy a financial plan application, make sure you have all the support and understand total cost. If you build in-house financial application, create a team of 2 to 4 people, including specialized programmers, user experience, specialists, and involve as well business, risk, and ESG specialists. Don't allow programmers to build your model. Don't allow only risk people to build your model. Have a diverse team of people which are building this model. You're building a software for management, not for programmers, okay? You're building a software for management. A software to manage corporate business and social objectives day to day. So this is what you do. And it shall stay in the company. It should be company culture. You need to have continuity. You train people as well to use it. Don't concentrate in 1 or 2 persons only, okay? So having said that, we're arriving at the end, right, Pavel? Do we have any
Yes, thank you. Thank you very much, Artur.
I think questions now, right?
It was really really good overview. I think the topics are much more complex, but I think we have limited time, and I liked really the way as you approach it and went through. I think we really heard good tips, for the inputs and outputs when you evaluate, when you build your model, the advantages, disadvantages of building model in-house or using existing application. I think you also emphasize on the importance of considering not just typical indicators, but also new opportunities, which gives indeed maybe new ways how to expand the business. And I think importance of the restructuring to be approved by the management and board, and always using the manuals when it comes to rules for users and also coders and programmers. And of course, towards the end, you also emphasize about the diagnostic of your financial model, which needs to be well adjusted, customized to your needs, to your plans. So thank you very much. It was indeed a really good webinar. And I think it's proven also by the number of participants who remained with us until the very end. In case you have any question, just now we have last 2 minutes or so to reply a question or two maximum, but otherwise we stay open to any question. Artur 2, for those who are eligible for SIFTA, Artur is available to deliver tailor-made trainings, or you can even apply with us for additional activities which are eligible under SIFTA. And we are looking forward to have you or your colleagues on our next webinars. I think you see, that this relatively short time we cover quite a lot. It's quite interesting. So already next week on social economy, financial instruments, and financing experience of organizations from Poland and from Romania. So thank you very much.